Devin Choksi, Managing Director of Clear Choksi Security, joins us live now. Devin, how ugly could it get today for us?
Yeah, well, good morning, Nikunj. Like yesterday evening, I think another factor which I noticed was on Dubai versus the rupee traded at around 64 levels, and coupled with that, the bond yields shooting up to 9.25 yesterday in Indian markets. I guess it is written on the wall. Probably it's a state of capitulation, which I have been saying, that people are finding it extremely difficult to operate in this environment. They would probably pull out money. We have seen TFIs pulling out money from the debt fund. Not as much of aggression still seen in the equity fund side, but most of the fund portfolio, on equity fund portfolio, which are ETF portfolios, they are back to dollars, and that is where they have started unwinding their positions. And you find a typical behavior in the market, including the kind of reverse arbitrage behavior that we have seen in last two trading sessions. So what you typically find is that there is general reluctance to get into the market. People are selling into the cash stocks and probably creating the future position through this reverse arbitrage situation, which is available due to the oversold market. All put together, my reading says that still the buying is not returning or unlikely to return, even though market is oversold. We might probably see a state of capitulation extending further and probably go into the direction of 50 to 50 to begin with. If it stabilizes around that level, Nifty stabilizes around that level, then we might see some meaningful bounce of 300-400 points. But otherwise, the market is showing a distinct weakness and could possibly go into the direction of 50 to 150. And if it is not stopping, then further downfall. But as of now, I believe 50 to 50 would be one level which one would target.
Even with the rupee now breaching 63, we've got a couple of downgrades as well coming in this morning from Citigroup as well as JP Morgan, slashing their index targets and of course pulling out money as well from the country. Do you think it's only a matter of time before we may actually stare at a sovereign downgrade as well?
So all these threats would emerge larger as we progress, and as we see that most of the ammunition which they had in their hand, they used it. The RBI particularly, in the process of tightening, in the process of protecting the rupee from going down onwards, then they have basically used, even the tightening measures to the fullest extent. According to me, few things could possibly change the scenario that I see. First thing which could change the scenario is that if they assume the growth trajectory once again and probably indicate that they want to reduce the rate of interest, there would be a kind of a knee-jerk reaction. The currency might further depreciate. But in any case, the falling currency, you can't stop it. Allow it to depreciate by about a couple of rupees. But if you give a kind of a strong signal at RBI level that you want to bring down the rate of interest very significantly and make a cut of about 100 basis points straight away, I would think that the economy would probably stabilize, because that is where some of the foreign investors would start getting positive signals that in coming quarters the Indian economy is returning back to growth path, and then the fall would get arrested. But this is an important measure. In the immediate term, it could have an adverse impact on the rupee. So whether the RBI gathers that kind of a courage to take this decision, if they do take, I do believe that the market fall would be arrested, and as the indication level is 50 to 50 according to me.
Okay, one more downgrade. This is coming from JP Morgan. They have changed their India weightage from overweight to neutral, and they clearly are citing rupee as the real culprit, which will rob economic growth and which will have impact on earnings going forward. Even yesterday, bond yields, they appreciated to a 5-year high. Do you think the real effect of this sharp appreciation in bond yields is still not getting captured in the way how PSU banks have fallen? If bond yields they stay at 9%, most of the PSU banks are likely to report a loss. So suddenly it's not about NPAs. Suddenly it is about their bond portfolio and their MTM losses, which really could create havoc.
Absolutely, Nikunj. Yesterday, in fact, my banking analyst put across this particular analysis to me, in which he suggested that it is total mark-to-market loss of on an AFS portfolio of close to somewhere around 45,000 crores for the entire banking sector. And I think the indication coming up is that in this quarter, some of the PSU banks may end up making losses. In fact, I was shocked to see the figure wherein I think a bank like Kanhaiya Bank would end up giving, I think, a huge amount of fall into the profits of almost as high as 60% due to this particular impact of mark-to-market because of the duration of the treasury portfolio. So I think this is going to be really a situation which one will have to look at. Even some of the private sector banks, in fact, I think the likes of ICICI, Axis and HDFC Bank, they also end up giving the loss of around between 1,000 crore to 2,500 crores on their bottom line because of this mark-to-market provisioning. It is certainly very disturbing. In fact, I think overnight some investors would probably look at the earnings on quarterly basis and then they probably find that how could suddenly I think this bank's profit drop so sharply. Though it is a mark-to-market loss, but yes, it is an important provision. And the size of the provision, 45,000 crores across the banking space, is quite huge as we see it.
Is telecom a good group to bet on in this kind of an environment?
Well, Nikunj, if you don't have any choice and probably you must park money, then you should probably. But honestly, I believe that I think this is the time to stay on cash. Even if the telecom probably is not having as many number of headwinds currently, I still believe that I think the kind of valuation at which most of the telcos are quoting at this point of time, it's not inspiring any kind of confidence in me to buy them into this market either. On the contrary, I would keenly watch at I think some of the significantly better down and oversold stocks in different areas, in different sectors. I think to buy into the portfolio when the market probably gives opportunity at the most I think lower levels, maybe I think during the sharp falls. So in such situation, I think you could possibly find some of the good quality stocks which are having cash in their balance sheet, which are low on dates and having a growth trajectory built in. I think those kind of companies which probably I think one could buy into the portfolio at lower levels, one should keep cash ready in hand. I for one I think wouldn't like to I think buy into telcos, though at some point of time Bharti and all I think would become attractive at lower levels, but that would be a trading position buy, not investment buy as I would call it.
Devin, what according to you though could actually lift off the market from this pain that we are in, and would it be something as severe as perhaps a rate cut from the RBI which could snap us out of this weakness?
Well, I think in this gloomy environment, probably I think that is the one thing which one would like to see, whether the rate cut happens in a quickest manner, and at the same time I think sharp rate cut has to happen. A gradual cut won't help because one, the RBI has employed I think a strong brake on the economic growth prospects I think for last 3 years. I think that is counterproductive, very clearly seen. So in similar situation, I think if you want to have the economy revival taking place, you will have to bring down the rate of interest faster than otherwise, and that could signal growth. See, our markets also believe I think more on the sentiments at the same time. If you want to signal growth, I think you need to bring down the rate of interest a little faster. It may have a consequential impact on the currency. I am cautioning that point in the short term. But at the same time, I think when the investors start seeing that the country is returning back to growth, at least the fiscal situation would start getting stabilized, and probably with the lag of around quarter or two, you would see the growth coming back into the economy. So I am for one, I think would be very clear that I think that would be the first action. A sharp cut in the rate of interest, I think would signal the first revival message I think to the markets.